Everybody, the Fed just lowered rates for the first time in more than 4 years. We're going to talk about the numbers, what it means to you, what it means to the stock market. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. There's a ton of valuable information on the site as well. Please take a minute and check it out, fool.com/Frankel. It's the best way to support this work I'm doing on YouTube. So let's dive right in. So as I mentioned, the Fed just lowered rates. I'm going to share my screen real quick. And not only did the Fed lower rates, but it did so rather aggressively. It cut rates by 50 basis points, which before this, experts were kind of split between whether it was going to be a single rate cut, which is 50 or 25 basis points or a quarter percentage point, or 50 basis points, but we got the more aggressive rate cut. It is the first one since the Fed did a big emergency rate cut in March 2020 when the COVID pandemic started. And it lowered the target range of the federal funds rate to a range of 4.75 to 5%. That's down from 5.25 to 5.5%. So it is a significant reduction. So there's a little bit more to the story. So first of all, the Fed issues a statement along with its rate cut that kind of explains what it did. We saw that one of the voting members voted against the decision, preferring a quarter point rate cut instead. But other than that, everyone else voted in favor of a half point, which is what we got. The big language changes are that job gains have slowed, whereas it used to say moderated. So the economy is starting to cool off, which is really why the Fed did what it did. Inflation remains a little bit elevated, the Fed says, but it does not seem totally concerned. And another thing that the Fed does at its meetings, or every other meeting actually, is, and I'm going to put this on the screen as well, the Fed gives its projections for the economy. So you can see here, and we'll go over this, you don't have to worry about all of these little numbers, but this is where the Fed sees the economy going over time. So as far as inflation goes, it's expecting things to cool off quite a bit compared to its previous expectations. PCE inflation at the end of the year, 2.3%. The previous expectation was 2.6%, and cooling off to its target rate of 2% by 2026. For core inflation, now it sees 2.6% at the end of this year versus 2.8% previously, and again cooling off to the 2% target rate by 2026. Unemployment, it sees unemployment a little bit worse than previous, which is why a 50-point rate cut may have been justified as opposed to a quarter point. Now sees unemployment at 4.4% for 2024 and 2025. Previously, it was a little bit better than that. And over the longer run, the same at 4.2%, but it sees it in the next few years as a little bit worse than expected. So that's why the expected path of interest rates is a little bit different than it was before. Now, so here's what this part means right here. The Fed is expecting another 50 basis points or another 2 quarter point interest rate cuts before the end of this year. That will be a total of 100 basis points or a 1% reduction in interest rates. By the end of 2025, it expects another 100 basis points or 1 percentage point. So a total of 200 basis points or 2 percentage points of rate cuts by the end of 2025. And you can see from the lineup below it, which was the last projections that the Fed made in June, this is significantly lower than the Fed saw interest rates going previously. So what does this all mean to you? So let me put the slideshow back on the screen real quick. It means different things for stocks and for individuals. So for the stock market, some industry sectors and individual stocks are pretty rate sensitive. I've written before and have done videos before about how real estate investment trusts in particular could be a big winner as rates come down. That's also true for other high dividend stocks. I like dividend ETFs in general right now. Any dividend paying stock tends to be a little more rate sensitive than non-dividend counterparts. Lower rates help these stocks for 2 reasons. One, it makes borrowing easier, which dividend paying stocks tend to be more mature, tend to be a little more reliant on debt, more comfortable taking on debt, and lower rates make borrowing costs lower. So it just lowers the cost of capital, and they also tend to cause inflows into stocks as risk-free yields go down. So, for example, right now, or until this Fed meeting, it wasn't that hard to find a one-year CD that paid interest rate of around 5%. That's going to come down. So as these rates on risk-free instruments like CDs, treasury bonds, high-yield savings accounts, as they come down, it, they look less appealing to investors, and the stock market looks more appealing as investors try to achieve better returns. So lower rates generally cause a lot of money to come off the sidelines and into the stock market. And if you've heard the saying, a rising tide lifts all ships, that's exactly what this is talking about. Money comes off the sidelines, helps out stocks. So this should generally be a positive catalyst for the stock market. The question is, how much was it priced in before the Fed meeting? For consumers, some consumer interest rates are directly linked to the Federal Reserve's movements. That includes credit cards. Adjustable rate mortgages are generally in the same boat. So, for example, if your credit card interest rate was 25%, and the Fed cut rates by half a percentage point, it should immediately drop to 24.5%. So that exact same interest rate move should be reflected in your credit card interest rate and any other kind of adjustable rate. Home equity lines of credit often have adjustable rates like that as well. Other consumer interest rates aren't directly tied to the Federal Reserve's movements, but they tend to move in the same direction over time. On the borrowing side, that includes mortgages, auto loans, and personal loans. Um, it's not a coincidence that mortgage rates have more than doubled since the beginning of 2022 while the Fed was raising rates. It didn't have a one-to-one relationship. Mortgage rates kind of oscillated over time, didn't rise quite as much as the Federal Reserve's rates would have, but they definitely moved in the same direction. The same is true for auto loans, personal loans. Those interest rates have gotten higher as well, so maybe we'll start to get some relief on those things. And on the deposit side, and this is the unfortunate part, savings accounts and CDs, their interest rates aren't directly tied to the federal funds rate, but do tend to move in the same direction. So if you look at the high yield or the online savings banks and things like that, you could expect to see savings interest rates drop roughly in line with the Federal Reserve's movement. For example, my bank account was paying 4.5% on my savings account before this meeting, so I would expect it to roughly fall to the 4% neighborhood. We'll see what actually happens. And when it comes to CDs, I would expect something similar, especially when it comes to shorter term CDs, which tend to track the Fed's rate movements a little bit closer. On the other hand, longer term CDs, say like 2-year terms and over, tend to be more based on future expectations of interest rates, which really haven't changed much. So, like the interest rates you're seeing on 5-year CDs might not change a ton, but 1-year CD interest rates will probably be more impacted. So that's kind of the rundown of what you need to know about the Federal Reserve meeting today. Definitely looks like a positive catalyst for the stock market. Stocks are responding positively to it. Love to hear any thoughts or questions you would have. I will do my absolute best to respond to each of them individually. And thanks for watching. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.